Happy midweek, everyone. Hope everyone is well. Welcome to another live show. We're live here from our Moomoo Singapore office. Once again, I'm your host, Olivia Higgins. But while we wait for a few more people to join us, here's a video crafted and curated just for you. Enjoy. Welcome back, especially to those who just joined us. Once again, I'm your host, Olivia Higgins. We're here live from a Moomoo Singapore office. But before we begin, let me remind you that today is about education. Do not take anything as financial advice or recommendations. Here, it's all about networking and learning together, okay? So I want to see those questions coming in. And if you're ready for the live today and the topic that we're about to discuss, type in yes right now, a big yes underneath in the chat box. Wherever you're tuning in from, whether it's YouTube, Facebook, or in-app, welcome to all our community users. Now remember, okay, we will pick the best questions for the end. So make sure that you type away and ask anything you want to our expert today on what you want to know about the topic for discussion. Let's hop right in. Today's topic, what to bring into 2024. You know, the year is ending soon. So now we're looking at wrapping up the Singapore market and also looking at, what you should pay attention to, are the possible drivers to also pay attention to going into next year. So today with me, you've probably seen him from MooFest and also from the SGX Group collaterals and live shows. From the SGX Group, let us welcome market strategist Geoff Howie. Hi, Geoff. Welcome to the show.
Thank you, Olivia. Great to be here.
Great to have you as well. And we've got a lot of our audience members tuning in to listen to your insights. But of course, for those of you who don't know Geoff, tell us about yourself.
I'm an Australian and I've lived in Singapore for 14 years. I work at Singapore Exchange as a market strategist in a role that really is about communication to the investors in terms of what's happening with our listed issuers and vice versa, working with the listed issuers to let them know what investors are wanting as well. So that's a role that I really enjoy and one that obviously has brought me here to you today.
Perfect. And I think it's great. The key word there was communications, right? The bridge to the audience and of course to educate them about what's going on in the markets. But today, Geoff, what is the objective of today's topic?
Well, I think this is the time of the year where we round up and learn what our good takeaways were and what to expect next year. Next year is going to be pretty important. It's a year of inflection in many regards because there's a lot of things that are meant to turn around per se. That's what the current consensus estimates are. There's also political inflections because there's a number of elections next year. And I think,
Absolutely.
it's good to look at what the stock market is doing, what it's been
Mm,
expecting, and let's say the inflections don't take place. What's plan B? Well, plan B
mm-hmm,
would be more of what we had this year, which is really companies looking within to optimize their operational efficiency and find ways to still add value from a micro
mm-hmm.
perspective, more so than a macro perspective.
Mm, a lot of changes there. So, what can Singapore investors then, really bring from 2023 going into 2024 from an economic perspective?
Yeah, it's interesting, right? Because markets always move ahead. So for the last few months, in fact, even just before the third quarter earnings season started, we
Mm,
were noting that the markets here were increasingly or determinedly looking towards next year.
mm-hmm,
So this year we've had obviously weaker external demand and tighter financial conditions. That's clearly moderated growth, and that's really been an overarching driver in the outlooks for all the stocks.
mm-hmm,
Global growth is expected to be similar next year as it was this year, albeit a marginally lower, and that's because your European growth acceleration is
mm-hmm,
expected to be offset by deceleration in China, Japan, and the United States. This is interesting though, because the IMF sees Singapore GDP growth slowing down to 1% or maybe just below
mm-hmm,
1% this year, but then more than doubling up to above 2% next year. That's in line with what the Asia Development Bank is forecasting. I think they're expecting 2.5% growth for Singapore next year. And it really parallels also what MAS's survey of professional forecasters
mm-hmm,
are. I think their mean expectations is 2.3% GDP growth for next year.
mm-hmm,
So why is that so? Especially when your Singapore NODX is now booked 13 months of year-on-year contraction and your industrial production's booked 12 months of year-on-year contraction. Um, that has been on the back of obviously the semiconductor down cycle,
mm-hmm,
and the lack of consumer demand, electronics demand and consumer demand from Asia. Um, but what we actually see next year is this inflection in semiconductors, and you also have this expectation that the World Trade Organization think global
mm-hmm,
merchandise trade um, really will accelerate to 3.3% next year from a pretty low rate of 0.8% this year. And that's critical because for Singapore, remember, we really are a trade-centered nation in many
mm,
ways. I mean, we're many things, but that's one of the traits we have. Exports
absolutely.
plus imports, three times
Mm-hmm,
larger than the global average and four times larger than the average for Asia even. So this
mm-hmm,
trade-centered nature of the economy here,
mm-hmm,
it also extends to a stock market. So 50% of the STI revenue. So if you trade the STI like a stock through the ETF, that stock has 50% of its revenue reported to outside Singapore. Then we also have a slate of between 80 and 90 stocks that report more than half their revenue to China or more than half their revenue to Southeast Asia, excluding Singapore. Um, Look, I think we've got upside risks and downside risks, but what really matters is, I think, from an investor perspective, and what
mm-hmm,
we're taking into next year, I guess to sum it up, is the slower global growth from the overall tighter financial conditions. It is expected to continue into next year. Um, and the issue is that it's because the these projections of 2.5% to 3% growth in global GDP next year, the issue is that's a product of policies that
mm,
really have been presented to the world this year as works in progress. So the investors of the fast moving stock markets of recent years, particularly during the COVID recovery, they've had to contend this year with these economic policy response lags across the globe. And that uncertainty, I guess, of the policy effectiveness, it has slowed down the broader stock market tempo this year compared to what we saw in 2021 and 2022, but it's still inherently obvious from some of the moves we've seen that investors are still on the hunt for policy pivots or ultimate inflection points, if that makes sense.
mm.
in Singapore, be it the stocks themselves or the investors that are in the stocks, they've had to contend with the impact and the uncertainty that comes with these policy lags, um, and that lesser broader growth that we've seen, and have to also find ways to optimize returns. Um, I guess I'm dragging this on, but it's kind of important because, as I said, trade is super important in
Mm,
terms of what's going to happen with global merchandise trade, as is what's happening in the US and China. The reason being that basic economic relationship, aside from contributing the most to global GDP, the
mm,
US is ASEAN's largest foreign source of foreign direct investment, and China is also ASEAN's largest trading partner, and ASEAN is
right.
actually China's largest trading partner since 2020. Okay, so
Mm,
the Fed funds rate, the contraction in global semiconductor sales, and that inventory overhang in semis, and the broader impact of the deepening property downturn in China all have this key role in shaping our outlooks next year. So there's inflection points to look for.
mm.
And if I could just make one more point for this longest answer in the world to your question, uh, that there's also that familiar risk or potential further global geopolitical destabilization, and that's
Mm,
firmly in the frame. And it's clearly evidenced by the markets. In fact, one of the most consistent asset classes over the last 5 years, the one that's outpaced global benchmarks, regional benchmarks over the past 5 years with a 9.2% annualized return over the past 5 years, is the Spider Gold Shares ETF. So that's
mm.
obviously that's obviously in the picture as well.
Right. And of course, you can definitely access that on the Moomoo app, wherever you're tuning in from. But let's deal with that later on with a quick app demo. Now, Geoff, the next question, you highlighted the different factors and also you're looking at the progression going into next year. Now, let's talk about the Singapore listed stocks and extend a bit further from that. So, what is the economic outlook for that? You already kind of touched on the several drivers to pay attention to, but let's go a bit deeper for this
Ye-
point.
Yeah, look, in terms of interest rates, the market fully expects the Fed Reserve to not move interest
Mm,
rates in a few weeks' time on the 13th of December. It
mhm,
also fully does not expect the Fed to move on the 31st of January. So it's full expectations of no change in the next two FOMCs. And this is a recent development.
mhm,
It is good news in that the Fed's preferred measure of inflation, which is the PCE core deflator, it's due next week, but the most recent gauge was for September, and it's now actually closer to the 2% target rate than the 5.5% rate back in September of 2022. For October, it's expected to be 3.5% when it prints next week. Now, what it means is about 5 weeks ago, there were close to 40% expectations there would be another 25 bips Fed funds rate hike by the 31st of January. So what we've got is, interestingly, this reaction in the market. The two most rate sensitive sectors are the trio of STI banks, DBS, OCBC, and UOB. Um, Back then, they were trading on average about 14% below their Refinitiv consensus estimate target price, while the six real estate investment trusts that are part of the STI were on average trading 26% below their Refinitiv consensus estimate target price. Now, the more dovish outlook for US interest rates over those 5 week period, it's coincided with those six STI REITs reverting closer to their Refinitiv consensus estimate target price over the past month. And that this Refinitiv consensus estimate, it really represents I guess, the average of the individual estimates from all the analysts that cover the actual stock or the REIT.
mhm,
And they typically represent the opinion of stock performance over the next 18 months. And they're all available on the SGX stock screener.
mhm,
Now, what's happened is the REITs they reverted a lot. So they were on average around 14% below their definitive consensus estimate target price, just like the banks were. Now, if the expectations for a rate hike actually turn and build, let's say PCE core deflator doesn't come in as low as we expect at 3.5%, then you would be expected to see this weigh on the stock market and potentially weigh on the REITs more than the banks. But overall, for next year, the market is currently expecting that there will be 100 basis points of cuts throughout the 8 FOMCs. You have 4 incoming FOMC voters, 3 of which are known as dubs. Only one is known as a hawk. So overall, it's a slightly more dovish cohort coming in to the FOMC with Mary Daly, Loretta Mester, who's at Tom Barkin, as well as Raphael Bostic. So that's that's how things are moving. Markets, as I said, are really looking towards 2024 at the moment, and that's clearly been evidenced in those 2 segments. And they are two very big segments of our stock market. 25 cents in every dollar that goes to work in our stock market every day is going into the 3 banks, and around 20 cents in every dollar is going into the S-REIT sector.
Banks and REITs. Now, the next question then, from an educational perspective, maybe we could really help our audience here. Why are sectors like banks and REITs so sensitive to the interest rates that you mentioned before?
So for the trio of STI banks, DBS, OCBC, and UOB, the net interest income makes up around 2/3 of their total income. And for the first 9 months of this year, combined net interest income was up 30% year on year. Now, what drives net interest income is the net interest margins as well as loan growth. And the net interest income has been up on net interest margins. The net interest margins are the net rate between what the banks pay on their liabilities and the difference between the rate that they receive on their assets. And the higher the overnight policy rates, the generally higher the net difference in those net interest margins. So they've been above 2% this year compared to below 2% last year, that net difference. And what that means is the trio have also reported combined net interest income of more than 8 billion Sing dollars for a quarter for the last 4 consecutive quarters. And for context, the combined net interest income of those trio was between 5 billion and 6 billion for the 4 years between the first quarter of 2018 and the first quarter of 2022. And then I think it broke above 6 billion in the second quarter of 2022 as we saw rates lift off. So this has a big impact. Loan growth also contributes to net interest income. So here's the thing. The banks have been strong initially on the higher interest rates, and the 3 were going or positioning themselves going into this year expecting single-digit percentage loan growth. However, they had to revise that to low single-digit, and we've seen flattish loaned books, if you will, basically on that outlook for trade deceleration across the world on the back of those tighter financial conditions. So the tighter financial conditions, they have this lagged effect. I mean, usually a Fed funds rate move has a 12-month policy lag full impact on the economy, but it's working through the system. So the loan growth is declining somewhat on the back of the higher rates. They do have a better outlook for growth in 2024. And as we said, we expect Singapore's growth to more than double up next year. And what happens is you will have potentially lower rates. And because of that, UOB is projecting mid-single digit loan growth next year. DBS noted that for next year, while you have higher for longer rates that support net interest margins, there is a likely trade-off with loan growth. And Piyush expects for 2024, his net interest income to be around this year's levels, and net profit to also be maintained around this year's level as well. So overall, Singapore loan growth has continued to be tepid overall and declined this year on the higher for longer outlook for the Fed funds rate. And So investors should, I guess, keep in mind as well that when you have this flattish loan growth as well, the banks can also get quite competitive for their loan market share, and that could also see a reduction in yields and mortgages and corporate loans as well. So that's one thing. That's kind of how it works from the banking sector, if you will. That's why the banks have
Mhm.
performed so well. In fact, if you look over the past 5 years, your 5 year total return for
Right.
DBS Group 78%, UOB 43%, OCBC 48%, which is well outperforming the STI. But that's just from
Mhm.
the banks. Did you want to look at the REITs as well, or you happy
Definitely. I
with
think
one?
the REITs component, especially the industry, the audience members definitely want to know more about this. It's certainly a hot topic within our communities. So perhaps, Geoff, you could expand on the insights related to REITs for Singapore.
Yeah. So there's three perspectives in terms of how REITs have been impacted from what's been happening globally so far this year. Uh,
Hmm.
have I got the yeah. So firstly, what happens in the US really matters because the REITs
Hmm.
have been in the US for a good 60 years. 70% of the world's market capitalization of REITs, so all the global REITs, 70% of all that value is actually listed in the United States. So as you can imagine, what happens in the US does have a big tidal impact on the global REIT market, particularly through high interest rates. And look, the US Fed Reserve's financial stability report, it was released about a month ago, 6 weeks ago. It signaled increasing concerns about the inflationary pressures potentially leading to more restrictive monetary policy, which meant the prospect of large losses in commercial real estate. However, if you look at what JLL, CBRE, Knight Frank, they're all looking at potential stabilization first in the global commercial real estate market next year, and potentially inflection in there as well. Then that's what their outlooks, or their 2024 outlooks, have been saying. So that has a big impact, pulling the tide, pulling the valuation of the whole sector down. I mean, you think of it as an international portfolio manager. If the REITs here, sure, their DPU, their leverage ratios are all comparatively competitive, you're still going to have your overall valuations pull down from what happens in the big part of the pie. That's just the way markets work. Why pay more here when I can get it over there for so much cheaper in terms of valuations? And the second part is higher
Mm.
treasury yields. They also provide more competition for investors' wallets. The average dividend yield in the S-REIT sector is 8%, and the index trailing yields, they're around 6%, forward yields closer to 7%. By comparison, your Singapore 10-year bond yields are around 3.4% at the end of October, but they have come off quite a bit with that change, structural repricing, or refreshed outlook for rates next year, and they're now
Mhm.
closer to 3.1%. But it brings the REIT index yield premium spread now back to its longer term average of around 380 basis points. So what I'm saying is your average REIT index over the last maybe 5, 10 years has on average been 3.8 percentage points higher than what the Singapore government 10-year bond rate was. Um,
Mhm.
and that spread did come in quite a bit in February this year. And you remember
Yes,
there was a lot of the interest in the T-bill subscriptions and so forth. That REIT premium,
absolutely.
yeah, that
Mhm.
came down from what was it, the long-term average 380 basis points down to 275 basis points. So it did actually conflate somewhat. But the
Mm.
third thing about the REITs is that the higher interest rates, they're typically associated with higher borrowing costs and therefore lower distributions available for the unit holders. So for the REIT investors that want to do a little bit of homework, a key metric to closely monitor is the gearing ratio, commonly calculated just by taking the REIT's total debt divided by the total assets. We update this monthly in our REIT chart book. The average gearing ratio of the S-REITs and the property trust sector is currently 38%, according to the most available filings. Now, to hedge the impact of rising rates, S-REITs have been actively managing their interest rate exposures. Going into this year, I think on average, close to 75% of the S-REIT's current debts were entered directly in fixed rates or hedged through floating to fixed interest rate swaps. So that's the three things, if you will, that are having the impact on the REIT market and seeing the valuations for the REIT market and the price to book ratios come off quite a bit this year. But as I said, we had that sharp reaction so far this month, particularly after the 1st of November FOMC. You can see in that FOMC that this is the cool thing about these 8 FOMCs to watch next year. It's not just the very well prepared narrative that the Fed chair reads out at 2 a.m. Singapore time, but it's that press conference that clicks in at 2:30 a.m. And in the November one, there's probably 4 questions where he made these qualitative comments or qualified that it's the cool thing is that reminding everyone time lags still take time, that the impact from the rate hikes this time earlier last year, are still working their way through to the US economy, which basically, gave more expectations that we might be done with rate hikes and you could have that inflection reduction next year, as opposed to thinking it was going to be this year when we went into this year.
Mm-hmm. Very comprehensive. Thanks, Geoff, for that, because we've already got questions coming in. Now, for
Awesome.
the audience, wherever you're tuning in from, keep those questions coming, because towards the end, for the second half of this live show right now, we will be picking some of the top questions to ask our expert today. Now, Geoff, we have a lot of questions on the US Singapore side, so let's leave that for later. But to round up our discussion, what other segments of the market can we spotlight going into next year?
Yeah, I think the real estate is going to be really important because, okay, if you're looking at inflection, as I said, JLL, they maintain the impacts of economic uncertainty and the higher interest rates that have been very evident in global real estate markets this year, but there are encouraging signs for improvement next year. And they've added that next year could mark a turning point for US office space. That's pretty important. For the China housing market, this is a big one in terms of how it's been impacting broadly the China economy and by extension, its largest trading partner and our largest trading partner, Southeast Asia. Look, it's the downturn has definitely deepened, but the IMF did come out in November after consults, as they do with their typical Article 4 every year, and they discussed a number of measures to support the primary market to see a quicker recovery, lower economic costs, and so forth. So there's 5 key things, and I won't kind of relay them here, but I can assure you they all make sense. And this is the thing with the China housing market, it's easier to fix than it's easier to work out when to stop cutting rates and so forth, and much easier than the challenges we've had to contend with over the last 4 years of COVID. That IMF, there's things that there's policy support, if you will, that can look to support China policy makers as they deal with the problems in the housing market. The segment I think that has been the most interesting for investors is the AI impact. Right. The 2024 rebound in global semiconductor cycle, it's expected to continue right through to 2026. And that's with all this wafer shipments and demand and need for silicon, etc., to support what the artificial intelligence books will look like. High performance computing, 5G, and automotive and industrial applications are also really important for that. In fact, when you look at the AI plays per se in the US, they span these 3 categories of stocks. It's either software, hardware, or industrial application. And there's about 30 or so sub-industries, which is basically when you're looking at this level, you're going to the sixth level of revenue that a company reports. So it's beyond the usual, the GICS and the FTSE ICB ways they categorize stocks, sector, subsector, industry, sub-industry. You're looking beyond that, and you're looking at the actual revenue of the companies. And there's these 30 or so very key segments and sectors which I can share somehow. I mean, it's on the SGX website. I'll find a way. Yeah. I don't envy the investors to go fishing for it, but it's there. You can see the actual stocks and the actual relevance of that.
Definitely. You
Yeah.
definitely have to check out the website. But just to summarize for them, Geoff, perhaps you could maybe give them a window towards that.
Yeah. Look, we've got one here, which is a business in there, but if you well, it's not actually in the index, but it's in the relevant of these relevant 30 different sectors. It's like I said, it's either hardware, industrial application, or software. And we have here a number of stocks that are very relevant to those 30 industries in terms of they're what we call adjacent industries. They're associated with the hardware, industrial application, software stocks. AEM Holdings has continued to invest in its developing suite of test 2 level innovations and capabilities. That's bringing its testing applications up to the right level required for high performance in computing and AI services. You've got UMS also believes that semiconductors will benefit from the AI boom. And on the software front, I think Silver Lake Access it's a Malaysia-based provider of software services to ASEAN banks, and it maintains artificial intelligence, machine learning technologies are widely being used in the banking sector to automate routine tasks, and it's addressing this with its new cloud-linked solution. So there's a number of companies that are involved and have customers that are a part of the AI drive. And what it comes down to is the impact on the value chain. And basically though, as we said, we still haven't hit that inflection point yet overall for semiconductors. So as much as you have all this buzz, you've got the 2023 overcapacity and the chip glut, but that's been juxtaposed with this demand spurred by AI applications in next year and beyond. So this is one segment of the market that is being watched closely. Originally, I think the plan or the thought was you'd have the inflection point at the end of this year, but this market is expecting it obviously pretty soon, and you can see that in the performance of these semiconductor and AI related stocks in the US.
Great insights there, Geoff. We'll be back with you shortly to answer some of the burning questions from our audience members. Now that you've heard the analysis and also from that fireside chat, we're already getting some questions related to what Geoff was mentioning on the different factors and also related to the Singapore market. So we'll answer that right after this, but stay on because I'm just about to show you how you can access particular parts of the app for yourselves as a summary and also some useful tools for you. Okay, so if you have your Moomoo app with you, do follow through. Here is how it looks like when you go in. So when you open your screen, this is how it looks like. You can go to the search button and you can actually look at the trending stocks right here, okay? You can actually filter it. So for the purpose of today, we're going to go for Singapore. So you can see under this featured list component, you can see the top trending stocks in terms of depending on what category you're looking at. So you can actually customize it yourself. You can also readjust it according to pre-market price and also the stock ranking, which actually gets updated all the time. Okay, so everything is in real time and everything gets updated for you. So for the purpose of this, for example, let's type in S68 for SGX as an example. And you can see the entire profile right here before you're ready to make a trade. Okay, so if you look at this, you can look at the profile You can adjust according to timeline, depending on your time horizon as well. And you can see the market position overview here, capital trend, and of course, interpretation of indicators. Everything is updated to point. And also look at the comments here. I'm always tracking this for every company that I'm looking at. For the news section, definitely one of my favorites because you're looking at the headliners for this particular stock that you're looking at. For example, of course, for Singapore Exchange, these are the recent news pointers that you should be looking at, and also the announcements that are being made from the company. And of course, the company overview, the financials, analyst ratings, company valuation. And if you go down, you'll have more indicators for yourself, such as the estimators and also the indicators that you like to customize. Okay. So if you want to find out more information, if you're new to this, for example, you can also read it from this information icon. Very, very straightforward, very easy for you to access. And of course, the balance sheets and also cash flows, shareholders, and company overview. So for example, you want to know more about the Singapore Exchange, you can actually head on to the company overview and look at the overview and summary of a particular company that you've chosen. Okay. When you're done, if you want to add it to your favorites, just press the heart right here. And of course, some of you are interested in this. You can go to Discover to watch the replay of today. Let's say you actually came in halfway and missed some of Geoff's points. You can go to Moo, go to Live, and you can see right now we're live with this show. You can always watch the replay right here. Okay, very, very straightforward, and I hope that was helpful for everyone. If you have any more questions related to the app or the actual product, do leave some comments down below and we'll pass it on to our product team or customer service team. Okay, let's invite Geoff back into the room for our live Q&A. Welcome back, Geoff.
Thank you.
Okay, first question. So for the US elections next year in November, how can I use that to also make decisions for the Singapore market? How are those two related? Because you talked about how the US is very intertwined with the Singapore market. So how will that potentially affect?
It will depend on the policy agenda with with either the existing administration or the new administration. Actually going to be in the White House in 2 weeks, and
Oh, wow.
I might get some on the ground color when I'm there, but it really depends on which way. I know we talk about politics being very polarized sometimes in the West, and that can have big implications for policy decisions, which in part can really impact the rest of the world. But thankfully, the biggest economic levers that are in the US are obviously independent of the administration. That's the central bank. And it's always been that way, fiercely so. So, if you have any doubts in terms of who's in control of monetary policy, there's a great book. Roger Lowenstein? Yeah, I think so. America's First Bank, and it's the one that the Fed Chair Jerome Powell always touts when he's running education. If you have any doubts about who's in charge of the U.S. financial system, it's a really good read for that. But if the Republic, it's too early to say now what impact it has, but what impact does it have on its investing? If it is going to be a big impact, it might change the way or the method of your deployment of capital. Typically, investors, if they're concerned about a big event that they know not very much about, that black swan, white swan type of predicament, then they sometimes just hold on to cash. But if interest rates are coming down and you don't want to miss out on time in the market per se, you can always consider dollar cost averaging, which has also become a very popular method of Singapore investors. That is investing a fixed dollar amount every single month or maybe every
Mm-hmm.
single quarter, and therefore averaging out that yield price. So you're not actually end up buying at a major high or a major low, and you end up buying more shares or units of the same stock or the same market when the
Mm-hmm.
price is lower than when the price is higher. And that way you take out some of that timing risk if you are looking to invest, or
Mm-hmm.
you also look for markets that are had their own intrinsic growth drivers, such as India. ASEAN is expected to accelerate next year. Europe is also expecting to accelerate. So there's a wealth of choices when it comes to looking across the world.
Mm-hmm. Thank you for that. Next question is about uncertain times. So, someone would like to know some of the ways they can hedge against their portfolio for next year, but also how they can potentially position it.
Yeah, as I said before, it's interesting, right, that
Mm.
gold has been the outperformer over the
Mm-hmm.
past 5 years. And that has been with us. Geopolitical concerns have been with us for that long haul. Now, looking beyond that, as I said, so much of the policies, particularly in the large parts of the world, whether it's U.S. monetary policy or China's structural policy in re-engineering its growth engines from investment led to consumer led, those policies take time and there's always this lag, and that's where
Mm-hmm.
investors have maybe been a little bit frustrated because we've had these fast moving markets of the past and now we have to contend with slower moving markets. So positioning themselves, I think, uh I'm very old school in terms of using what the resources that the market do provide. uh I believe in that, obviously. And the whole point of having indices is that you you have products now associated with indices like ETFs. The whole point of those indices is that they are passive strategies, if you will. If you will, that they're meant to be diversified. So many indices these days are also capping constituents to um, a 10% a 10% limit. And I think that is one rule that we just tend to overlook, that whole 10% rule. The fact that ETFs have been really successful when you look at their AUM growth
Mm-hmm.
over the past 2 decades. And one rule, especially for the UCITS rule, is if they are kind of passively managed, you don't have more than 10% exposure to a certain stock, or you might be looking at it from your own perspective. You might only have 10% exposure to this certain sector, or 10%. If it's 20% exposure to one asset, you then break it up into um, different stocks. You might have like a 20% exposure to stocks or 25% exposure to stocks, but 5 different stocks that make it up. So this is the thing. It's really up to your risk profile, how much risk you can take, timing as well. As I said, you don't have to go lump sum, uh, and also if you are looking at your portfolio and that you do have existing stocks in there, then you might look at, what does the consensus target price tell you in terms of, is it close to it? Is it very far off?
Mm-hmm.
And then also look at valuations and the financials of the companies as well. It's something that I can't answer. All I can just try and offer and say is that we do have all the resources there to help you, and you also have independent financial advisors in the market and remisers,
Mm-hmm.
and particularly with Moomoo, who can also help guide your way. But diversification really matters, and you can diversify, as I said. That old 10% rule has lasted, and it's been a big part and a backbone of a lot of growth in investment products. Just keep it in mind. You don't ever. You do read some horror stories about people that have lost a lot of money,
Mm-hmm.
that have put in a lot of money in one particular name. It's just crazy. That's not the way our markets work. We've got a whole host of stocks, a whole host of segments, whole hosts of sectors and country exposures and everything has its own timing. There's an economic reason for everything the way it works in our stock market. Is just getting to align with what and understand what the market currently expects. If it gets
Mm-hmm.
worse, then current expectations, prices come off. But at the moment, um, as I said, it it's it's a market that has had uncertainty, but there's a lot of potential inflection points coming next year. So be on the lookout for that. Like I said, the industrial production in the NODX has been in contraction for a good 12 months. Actually, is it 13 months now for one of them? But it's been so long that you'll see the signs. You'll be in the front page when we start turning a corner and so forth. And it's not just Singapore. We've had the contraction in our NODX. At the same time, Taiwan's had the same contractions in their exports, South Korea as well. And this is to do with, as we said, this technology down cycle's a lot to do with it.
Mm-hmm. Thanks for that. Next question. So, someone like to know about, I guess, the lesser known emerging companies within the Singapore exchange, and also, is there any potential for investment opportunities next year?
Yeah, what, and I think we're hooking up with your content providers as well, because what I
Mm,
love doing at the end of every year is looking at which stocks burst onto the scene, so to speak, not in terms of performance, but in terms of trading turnover.
mhm,
Stocks that came into our top 100 by turnover,
mhm,
that used to be outside the top 100 by turnover. And there's been a number. There's companies like um, the Tianjin Darentong Pharmaceutical Company that has actually been on the right side of a lot of the Chinese reforms in traditional Chinese medicine, as they've been
mm,
trying to take all the non-regulated providers off the shelf, and
mhm,
the regulated ones have been able to stamp their authority in the market, and that for the financial year to date has been good for that company. So there are, if you say, those emerging companies that are there.
mhm.
But as I said, it's a pretty wide shelf of companies that we have, and some
Right.
of them are very unique businesses. It's just getting the right timing right. I mean, the one company, Acrelist, last year, not this year, it burst onto the turnover rankings because it was a catalyst company that I think had booked its first big major contract. I think
Mhm,
15 million Sing dollars it might have been, but it was for this company that basically provide the stainless steel mesh and in the clean rooms for the semiconductor companies and so forth. So um, these things happen. It's just you've got to be following the news, I guess, and then can take some time out, which I'll do soon as well, to just assess how how many companies actually did see their turnover increase and come into that threshold of being among our top 100 trading companies this year.
mhm.
Um, but there,
Certainly.
but there's one that question was also reminded me there's one key segment we didn't cover before, which is
Mm,
intertwined with the economic development of Southeast Asia incredibly, and that's the alternative energy, and it's one that a couple of our well, more than a couple of our SDI companies are really taking a lead on,
mm, mhm,
and um, yeah, so if you look at within the energy sector, you can have some I guess, pure play climate solution companies, um, such as renewable energy companies. There's also power generation companies which will no longer add coal-fired generation capacity and only build the new renewable projects. Um, Now, looking at how much renewable stock or power there is, gigawatts is the key metric. And your assets like solar and wind, they
mhm,
don't kind of, to a lesser extent, hydropower, they don't provide the same base load and don't generate electricity 24/7 like the conventional energy does. So you've got to apply a plant load factor. Now, this metric that I think will be increasingly important for investors that are looking in this emerging segment is that plant load factor. Or the gigawatts per se. So um, if you take a plant load factor of around 15% for solar assets in Singapore and assume the HDB numbers last year in terms of HDB average consumption
Mhm.
of energy, 1 gigawatt of power would
Mhm.
be enough to power 270,000 4-room HDB flats in a year. So this is the new way, I guess, to look at it.
Right.
Keppel Corp has been our 11th most traded stock this year. Its renewable energy portfolio is now 3 gigawatts. It's
Mhm.
it's That's 60% of its total energy, and solar makes up around 2 gigawatts of that. And then Semcorp Industries has added, I think it added 2 gigawatts in the first half of this year, and its renewables capacity is now at 12 gigawatts. This is mostly in China and India, but it's also aiming to be at 25 gigawatts by 2028. And this
Mhm.
is really important because part of net zero
Mhm.
isn't just cutting and becoming better citizens and managing our carbon footprint, but we actually
Mhm.
have to build the infrastructure. We actually have to build the solar and wind infrastructure, and we don't have a choice. And we've got these STI companies that are doing this. Keppel in
Right.
this region, Semcorp more in China and India. But this is an emerging area, and these two stocks
Mhm.
also have been among our strongest performers this year. And we've also got this also impacting green shipping. So green shipping has
Mhm.
been really important as well. Yangtze
Absolutely. I
Jiang,
was about to bring it
yeah.
up.
Sorry, I'm
Yeah.
always talking.
I think it's great. You're just we're really on a roll here with that topic. Geoff, I got a question here on the Singapore Green Plan 2030. Yeah. So let's extend a bit more on that. Perhaps, yeah, maybe even on the shipping point, or maybe in the infrastructure or the EV space. Because we know that cars in Singapore, hold a special place because, of course, with the COE prices being volatile as well and also going upward, people are talking about what the plan is, and is that, with Singapore's trend and trajectory towards this green plan, where
Mm.
are we, and where does SGX Group come within this space?
Oh, that we love to champion everything green. So not just stock prices going up and
Yes.
so forth, and the money to come in and pay for them, but we we've taken our sustainability drive very, very seriously. I think for some time now. I think it was one of the first, if not the first, in 2016 to introduce
Mm,
sustainability reporting. Um,
right.
but it's one thing being a platform and a provider, but having the companies themselves like Neo, which is
Mm-hmm,
among our 50 most traded stocks every year,
mm-hmm,
well, since it's last listed last year. So every day, I should say, it's among our top 50 traded stocks. Cetrium as well. I think its order book is now 40% renewables or cleaner green solutions. And Yangtze Jiang Shipbuilding has also made a breakthrough in the clean energy vessels. And I think its current out order book, it's something like 180 vessels, of which 56% is cleaner, greener, which is up from 23% mid last year. So uh, the companies themselves are really
mm-hmm,
taking the initiative to
mm-hmm,
see the infrastructure make the tilts and the pivots, and for us as well, having not just the stocks but also the fixed income front as well, with the green bonds and the sustainable linked
mm-hmm,
bonds is super important as well, because look, at the end of the day, it's got to happen. The thing is you might want to look out for, though, is the transition. So
mm-hmm,
the market's always sort of thought, okay, there will be a transition stage, but if it becomes to a transition that is going to be disorderly, then
mm-hmm,
you will see, some pretty fierce investment flows, or maybe some of that has been built into the market already when you consider the share price performances. I mean, year to date, let me have a quick look at the screen. Year to date, Keppel is up 46%, while Semcorp is up 53% in total return. 5 years, Keppel is up 100%. 5 years, Sembcorp Industries is up 330%. So maybe there's been some, pricing in there as well.
Mhm.
Yangtze Jiang's up 180% over the last 5 years as well. So caveat doesn't mean anything for the next 5 years, but this has just basically been on the back of the need for this incredible infrastructure bill that at the end of the day, Singaporeans don't want the Singaporean government to pay for. They don't want their tax money to pay for. And that's the same
Mhm.
as 30 other countries across the world that had surveys at 1,000 households that the IMF conducted. So I think we will see it here. In Southeast Asia at the moment, the electronic vehicle space, it's mostly where the growth has been is upstream in the mining,
Mhm.
cobalt, nickel, copper, lithium. That's where a lot, particularly Philippines, Indonesia, and then the midstream in Thailand. But it's also opening a lot of opportunities for businesses here, as we say. But you'll see it. I mean, we just need more charging stations, and then you'll see more cars.
Great stuff. Thank you for that. I've got another question. Also, just to stop you right there, because you mentioned NEO as well before. So, for those of you who want to know, you can actually watch the replay of our interview with the CFO of NEO and SGX Group on our YouTube channel. So, go to our YouTube Singapore channel and watch the replay of that if you want to find out more, some insights or introductions towards that. Okay, next question is, I will take this as the final question for today. So, Geoff, let's break it up into two parts. Someone would like to know the key trends within the Singapore's healthcare industry and whether or not it is time to invest in that. And the second part of that is also the trends within the family office space coming into Singapore and that being on the rise.
Yeah, the for the family. Okay, take the last one first. The family offices, there's supposedly between 500 and 1,000 set up here. Uh, I think they look at the market as most investors do. The
Hmm.
the thing is, I don't know what exactly they're looking at. I mean, I have
Right.
met with some reps and talked about our stock market, particularly
Hmm.
a lot of interest in new investment
Hmm.
themes, sustainability and so forth. So, uh, that's you'll see more and more that next year. There are some guys who are quite active on social media that representing family office associations, and they provide updates and so forth of what's happening. But they're just like everyone else, looking to make money and reduce their risk, and do it in a way that's comfortable with their risk profile. So they'll be looking at the same opportunities as all of us. For the healthcare, for a long time, it was personal protective equipment and medical gloves and so forth. Healthcare, there's a big difference between healthcare products and healthcare services. The
Hmm.
healthcare products, aren't just like I said, the Top Glove, UG Healthcare, Riverstone, they're our glove providers. But those gloves are not just used for health purposes; they're also used for clean rooms as well in semiconductors and AI research and so forth. So that's pretty important to consider. Raffles Medical Group's probably our
Hmm.
most traded healthcare play. It's trading at around $1.08 thereabouts. Its consensus target price is $1.29, so it's trading around 20% lower than its target price. And I think most of our stocks are in that vicinity, trading around 20% lower.
Hmm.
But yeah, year to date has been pretty flat. I think the stocks hasn't really moved too much in that regard. And I did mention Tianjin Zhongxin Pharmaceutical as well. Parkway Life REIT we consider a healthcare play as well, and that's actually pretty. Am I looking at? Well, I'm not looking at. Well, it's down 3% year to date. Sorry, Raffles is not flat. Raffles is flat this week. Raffles is actually down 20% this year. So that's why I guess it's trading at 20% discount to its target price. Hasn't I got that right? 20% down 20%. Yeah, year to date. And up still 10% over the last 5 years. And then for Hall Park Corporation as well, that's actually up 7% this year. So Tiger Balm and a little bit of tourism business as well there, probably a bit more than a little more. But yeah, and then Parkway Life REIT is one of the more defensive REITs, only down 3% this year. So where's Parkway Life REIT's around 20% less than its consensus target price. Hawpa doesn't have enough analysts covering it. So different performances. Even though it's one sector, this is one that you do have, I guess, more asymmetric returns than you might see in the banks and the REITs. So if you are in the healthcare sector, very important to diversify over different stocks. And
Thank you so much.
yeah.
Thank you so much, Geoff, for that. And to the audience for your questions. Now, if you want to see a part 2 for Singapore market with Geoff Howie next year, perhaps, type it in the chat box right now if you want to see more of this. And that's all the time we have for questions. We have more questions coming in, but of course, we took the top ones for Geoff today. Now, Geoff, before we leave the audience until next year,
Yeah.
let us know, what is your final takeaway for everyone watching today?
This is a great country, and it's a great stock market. Don't believe everything you read.
Excellent. Now that was Geoff Howie, SGX Group, everyone. See you for our next show together. And of course, except this time, it'll be next year.
Look forward to it. Thanks so much, Olivia.
Thanks, Geoff. To the audience, if you have any more questions, remember, you can still drop us a message on the chat box and we will keep track of it, okay? We cannot wait for more upcoming content. Of course, a long-term partnership with SGX Group. We're always grateful to have everyone with us and, of course, be the bridge to experts like the SGX Group and Geoff today. So we hope you learned as much as we did, and we will continue to guide you through financial literacy and also your educational journey towards a smarter investment future. So you can follow as well if you want to keep track of the next live shows we're having upcoming for you. Very exciting. Follow our in-app and social page right here by scanning the QR codes right here if you want to see the replay of today. As always, it was a pleasure having everyone with us. We'll see you for our next show. In the meantime, it's almost the weekend. We're at midweek. So we hope you have a great evening ahead. Once again, you're with me, Olivia Higgins. Happy investing, everyone.